What is contrarian investing?
Oh, okay. Well, let's actually go back to this slide again, and we'll share it in a way like this. So, contrarian investing, when the fear is high, you buy, right? Just think of that. When the fear is high, you buy. Now, the most amazing thing you'll find is that the average person is doing exactly the opposite, right? That's it. That's the difference between professional investors and average investors, is that they have a high enough understanding of how these things work that they're actually more interested in buying when things are falling than they are of selling. So, this is the buffer that I think we provide, or advisors provide with, our clients. I know that there's a lot of people out there say you don't need an advisor, you can go do all this stuff yourself, and that's true in today's world. But one of the things that does happen is oftentimes people on their own will panic. Whereas a professional manager like us, who've been doing it for over 35 years, would look at that and say, okay, this is the time to be actually buying right now. And maybe it is time to panic, but here's why, and here's the facts and the data and the research that goes behind that, where it's time to pull back some of the stock pieces. I mean, that can happen too. But so VIX is one measurement of fear. So when that gets above 30, 33, that's a contrarian sign to buy. The fear is high, buy. Here's another one. This is the American Investor Sentiment Survey, American Association of Individual Investors, AAII. And this comes out every Thursday. So this just came out yesterday. And you can see here the bullish is 19.4, which is very, very low. If you go down below, the historical average is actually 38%. So it's half what it normally is. And what they're asking is, very simply, do you believe the stock market's going to be higher in 6 months or not? Well, 58% think it's going to be lower. That's a pretty big number compared to, again, 30%. So it's almost twice as many people, of course, think it's going to be bearish. Again, using this as a contrarian indicator, you can see this little dial right above us. It's at negative 39. And so basically greedy means the farther that gets over, the more you should be buying if you're a contrarian and you're coming in and buying when everybody's leaving, because the fear is getting high enough. Versus fearful, which is where, everybody's buying and you're starting to get nervous that, that's going to peter out, right? Because it does peter out either way. Everybody sells and sells and sells, and pretty soon they're done, right? And then the only thing left are the buyers to come back in and move it over. And that's essentially what the contrarian is relying on. And there's one more measure here. And this is, we just saw this today. This is the B of A bull and bear indicator. This is a proprietary indicator that they have, but I would assume it's a basket of different contrarian indicators that they're looking at. It's extreme. It actually went from 0.2 in this chart to 0. And so really, people are super, super bearish right now. I mean, and again, what that means is, theoretically, that all of these people have made their moves. They've sold and sold and sold, and that leaves the few buyers that are still out there, the contrarians that are coming back in and buying that dip, and they might have an outsized impact on the market because there's nobody on the other side anymore, and so pretty soon there's a lot more buyers than sellers, right? And so that's what that's talking about when they talk about being a contrarian. It's coming in, and long term, this is a really good strategy. And some of the best investors in the world, Warren Buffett's been buying recently, right? Mark Tobias with Franklin Templeton. There are people that are really, really good. I mean, again, they're walking in the door when everybody's running out, so that's where we're at right now. Now, you have to be a little bit careful because your situation might be different. What's the timeline you need this money for? Because things could continue to do poorly for a while. I'm going to buy a house at the end of the year. Well, you should not be walking in when everybody runs out. You probably shouldn't be in there in the first place, right? That's too short of a goal. I see that all the time, by the way. And so, that type of thing. Hey, I'm 40 years old. I'm going to retire at 65. I hope I'm going to live to 90. Well, okay, you can suffer some loss and you can keep buying those dips. Be brave. all the way through, because heck, even the Great Depression came back in 14 years. And so there's a chance that you're going to come back in your lifetime, even probably before your retirement. So your age, your outlook, your risk tolerance, what your cash flow situation is like, how much money do you have on the side that you could live off of if the market didn't do well for a while, will really determine how much of a contrarian you can be. You have to be careful.
And the market's never gone to zero, and so but you also want to take some kind of, is this within my risk tolerance? Because if you take on too much risk and you stop sleeping at night and you're looking at the market constantly and seeing red and it's giving you anxiety, then this is not a strategy for you.
Right.
So there has to be a balance between what you can handle, what you can stomach.
Well, one other key component here that we didn't talk about was just, what are you buying? Okay, so you got everybody's running away from this little company that doesn't have any earnings, barely has any revenues, and you're running in the door on that. That's a totally different deal than, hey, everybody's running out of the S&P 500, and you're walking in and buying the S&P 500.
Yep.
Because that little company can go out of business, right? We've seen a lot of them go out of business. And so, if you're going to do that, at least buy a basket of little companies, maybe an ETF, Russell 2000 or something, if that's really what you want to do. If you're going to do the little company thing, make it small, because if it works, you'll make money, but there's a contrarian thing where you're just running off of a cliff that there is no bottom. It goes to zero, and your portfolio goes with it. So I do think that needs to be understood. When we're talking about contrarian investing, you have to be a little bit careful about what you're getting into as far as that goes.
And like Warren Buffett, he tends to buy quality companies that are down, kind of on the down in their cycle. And so he's not buying these small companies. He's buying, Coca-Cola. He's buying all the big companies, and he feels there's value to be had by when they rebound back up.
Yeah, exactly. I mean, I always tell the story about bingo.com. 2000, 1999, whatever it was, client calls up, wants to buy bingo.com. So I look it up. It went from $1 to $9, like overnight, 6 months. Huge rate of return. This was, the .com bubble, no doubt. And so I look into it. It doesn't have the ability to do. They never got approval to do bingo online, but that's what they were trying to do. They just filed a public offering, and so then it started to fall. It had come down to like $8, and this client was excited. Oh well, it did so well, made some money. The online, bingo is going to be hot because it is popular, right? But they never had approval, so then they have a company. They didn't have revenue, no earnings, no nothing. It didn't have approval, so trying to buy that on the way down, it went to zero. E-toys, right? Big runner up, went to zero. So you got to be careful on some of these, stocks. You're running into something. So keep those bets fairly small, in my opinion. Nothing wrong with making those bets. It's kind of fun, but keep them smaller. Yeah.